We're going to take a quick peek at number 6, right? So this is your work. I'm going to get rid of all the numbers that aren't right. So we'll take it from the start, right? Accumulated depreciation at Krug, their company's accumulated depreciation account has a $13,500 balance to start the year. There you go, credit balance, because remember this is a contra asset, right? Normal credit balance account. Reviewed depreciation schedules reveals that $14,600 of depreciation expense must be recorded for the year, right? So they're telling us we've used up $14,600 of our asset. So we're going to book that amount as the adjusting entry, right? 14.6 is the amount of the journal entry, right? So we debit depreciation expense, credit accumulated depreciation for 14.6. This credit's going to come right up to here, right? So it's going to be what? 14.6. Credit to accumulated depreciation. So if I add the $13,500 credit to the 14.6, what do I get? 28,100 credit balance. So that's what my ending balance in that account should be. Credit side, right? So we're marking the loss of usefulness of this asset. Okay, so that's A, right? And we didn't really follow their steps, right? Kind of, but we looked at this piece right here, right? 14,006 of depreciation expense must be recorded for the year. That gives us that piece, which allowed us to answer the rest of it, right? Think of these as a puzzle, right? Okay. Part B says what? Company has one plant asset that it purchased at the start of the year, cost of $44,000, life of 5 years, and no salvage value, right? Straight line depreciation. So remember the formula is what? Cost minus salvage value all over useful life equals our depreciation expense, right? So that means it's what? 44,000 minus 0 all over 5 years. I gotta do that math. Can't do it in my head. 44,000 divided by 5 years is what? 8,800 per year. Oh, what happened there? 8,800 per year. That's the amount of depreciation we record every year we use this truck, right? Did it at the start of the year, so we don't have to worry about any half-year period, anything like that. And there's no balance at the beginning, right? So there is a zero balance in accumulated depreciation because we just bought this at the start of the year. Remember, accumulated depreciation measures the loss of usefulness. Well, if we just bought it this year, we haven't used any of it up, right? So the beginning balance is 0 because we just bought it. We know that we're going to depreciate it by 8,800 a year. So depreciation expense, accumulated depreciation for 8,800, right? So again, we take that credit, we bring it right up to here, 8,800, right? So my ending balance is 8,800 bucks. Okay, they made that easy because we had nothing to start with, right? And then C, cumulative again, same deal. We bought it at the start of the year, so our beginning balance is 0. Look at that. That's awesome, right? Cost of 32, 7-year life, salvage value of 4,000, right? Company uses straight line depreciation to calculate, or straight line depreciation method to calculate it. Straight line is what? Cost, right? Remember our formula, right? Cost minus salvage value all over useful life. So here we're going to take what? 32,000 salvage value of 4,000 all over the 7-year life, right? So I'm going to divide 7 into 28,000, which happens to be what? $4,000 per year. Okay. Now you got this 4,000 right, but I don't think that's that same 4,000. I'm thinking you put salvage value in there, and that's not salvage value. It's depreciation expense for this year. So again, we booked this for $4,000. That's zero. That's $4,000, which is our ending balance, and we already got that, right? But remember, this didn't come from here, right? That didn't come from here. It came from us calculating the annual depreciation. I hope that's helpful for you. Okay, now we're going to look at this last problem. This is like 35, 35, 6, and 7, I think. Yeah, 35 through 37. So it gives you this information, right? And it kind of cuts it off on the side, but I hope you can kind of see what we're talking about. You can follow it on yours. This is from your homework. So it gives us all the information. It gives us information about adjustments, right? And then we start with what? An unadjusted trial balance, right? This is an unadjusted trial balance before adjustments, okay? Because that's important. You got to remember process, right? So we have that unadjusted trial balance. And then you came down here and you did all of those adjusting journal entries just perfect, right? You did them just like they're supposed to be. But the step that you're missing is now you have to take these and the balances and post them down here, right? So like for cash, first thing you got to do, this unadjusted balance, we need to go up to our unadjusted trial balance, cash debit of $34,000. So you need to come down right here where it says unadjusted balance and go 34,000, right? And you have to do that for every one of these accounts because that's your starting balance, okay? So the next thing you're going to do is you're going to take all of this information and you're going to come down and bring it down as the opening unadjusted balance, okay? And then, once you do that, then you're going to post all of these entries, right? So you're going to do the insurance expense, prepaid insurance. So you'll come down here and you'll find insurance expense, wherever it is. Of course, the very last one, right? Insurance expense, you're going to post that. And then you're going to, as a debit, and come up and post the credit to prepaid insurance. There you got that credit, right? So you're trying to skip a step, right? So when you do that, you're going to get all of the balances, okay? You're going to get all of these new account balances. And then to B, oh, you already got the balances, right? So you got that, you hard-weight that, right? Because this information here should have come from the bottom numbers in each of these, right? So you're going to do this a lot of sequence because you already got the hard part done, right? To be, there you go. You have the now adjusted trial balance, which would be the unadjusted trial balance like we have up here, accounting for all of the things that you've done here, right? So all you did was skip a step because you got that all right, it looks like, right? You just need to get these posted. So now you have the adjusted trial balance and you come down to the last one where you build financial statements. Well, you need to pull this from here, right? Look, you got tuition revenue of $131,400. So that tuition revenue should be $131,400, right? Training revenue, $45,000, right? So you're pulling all of these numbers from the adjusted trial balance. Same with statement of owner's equity. Same with the balance sheet, right? I'm guessing, I'm gonna look at this just to make sure. Tuition revenue. Yeah, I don't know where you got that. 7,500. What's the other one? Training revenue is 40,000. Where'd it go? Training revenue. Yeah, you're pulling numbers from unadjusted. That's what you're doing. You need to take them from your adjusted trial balance, right? That's what you got. So you still have you got a little backup work to do. And then this is going to be slick. Once you figure this out, right, where the numbers are supposed to come from, this will just fall together for you. So hope that was helpful.